Okay, a little about the slippage and RobotFX Fluid Expert Advisor settings. Starting from version 7.5, slippage has well, two functions. Let's start with the first one, the classic slippage. What does it mean? Basically, it's like some kind of buffer. It's the distance that you allow from the price to move. It is in pips, by the way. It's 5 by default. But on the chart, mind that it is in points. It will be converted automatically. It's also displayed here on the chart as a command. The slippage which is set in pips 5, converted in points on this chart, it will be 50 points. So it's the distance you allow the price to move, and within this distance, you allow the expert advisor to execute a buy or a sell command if the price will move well, less than this distance. If it will move higher, 5 pips plus 6 pips, 7 pips, the expert advisor will ignore the command. So, for example, let's see that we have a downtrend here on this chart, random chart. The price goes down. The expert advisor has a signal to sell, let's say here. Well, here is the selling signal. The price sudden moves 6 pips. At this point, the expert advisor didn't have time to, or the order didn't get time to be triggered by the broker server. And so, since we gave the order here and the price moved down here, more than 5 pips the slippage, which is the order is cancelled. It is no longer executed. That's the slippage, the classic slippage function. However, we use it in a different way. It's the same value, 5. This value, 5 pips or 50 points on this chart, it is also used as some kind of buffer when we trade using the HedgeZone recovery option. Now, take a look at this possible scenario. Let's say you open a buy here, a first buy here. The expert advisor will automatically place the pending sell here, a pending order, and it will create the auto recovery zone, which will be, well, the first buy, the first order, and the second pending order. As we can see, the price dropped and then rise again, triggering the sell, and then the next pending order, which would have been a buy, and now we have 3 buys on the chart. At this point, the price rises, let's say, enough to trigger to allow the expert advisor to set the break even for these 2 buys, this one and this one, and then drops enough to trigger the stop loss for these two buys. So at this point, we are not covered by the hedging trades because they have been closed already. Now, basically, or technically, the expert advisor places the hedging orders, the pending orders, well, if the price moves below this level, the buy level. Otherwise, cannot place the pending buy if it's above this level. Well, now we introduce this the slippage thing also here with the HedgeZone recovery. We want to allow the price some time to be sure it will resume up, and after that the expert advisor will open the 4th trade, which will be the aggressive hedge, another buy trade, but only if the price moves above the level above the slippage, the level plus the slippage distance, which is 5 pips by default. Again, change it to suit your own needs, by the way. And that was introduced because there was some scenario when there's another scenario actually when the price drops down and only a little enough to trigger the aggressive buy. So this buy will be here somewhere, but eventually it will drop. So we want to allow the price more space to move, to make sure it will either reject or drop further. It's exactly a buffer. In this case, it is used as a buffer. And this is the second use of the slippage. I hope you understood. If you don't have, well, ask a question or go ahead and download the demo Expert Advisor and feel free to try it on your demo account. Bye bye and good luck trading now.